Welcome to The Explainer. Today, we're going to break down a really pivotal day for the markets. The day the AI hype train didn't just slow down, it slammed on the brakes. We're going to look at what caused this high valuation shock and, more importantly, what it means for you. Okay, so let's set the scene. The day was Tuesday, November 4th, 2025, and this was the day that the seemingly unstoppable tech rally finally hit a brick wall, sending a huge shockwave of risk aversion all across Wall Street. And just look at the numbers here, a complete sea of red. The tech-heavy Nasdaq got absolutely hammered, plunging over 2%. The S&P 500, it had its worst day in 3 weeks. Even the Dow couldn't get away from the sell-off. This, my friends, is what we call a classic risk-off day, where everybody just runs for the exits. So, what on earth caused this sudden change of heart? Well, in this explainer, we're going to break it all down. We'll start with the one AI stock that really sounded the alarm, then we'll get into the wider economic fears, and finally, we'll walk through 3 potential game plans for investors. Let's dive in. You know, this sell-off wasn't just some random dip. It had a clear epicenter, and it all kicked off with a really strange paradox from one of the hottest names in artificial intelligence. So this is where things get really interesting. Palantir comes out with great news. They beat earnings, their revenue growth is picking up speed, basically everything you'd want to hear. Normally, you'd expect that stock to just soar. But nope. Instead, it plummeted almost 8%. The reason? It's absolutely sky-high valuation. The company was trading at 85 times its sales. To give you some perspective, that's like paying $85 for a coffee that only costs $1. And that sent a message loud and clear. Investors were done paying any price for growth. And that's what sparked fears that the entire AI sector was one big bubble. And then, just to pour gasoline on the fire, in comes Michael Burry. Yeah, the guy from The Big Short. He revealed that he was making massive bets against AI giants like Palantir and NVIDIA. His logic? He said the whole thing reminded him of the fiber optic craze during the dot-com bubble, where all this crazy investment led to a spectacular crash. You know, when a legendary investor like Burry makes a move that big, the market pays attention. But look, the Palantir situation and Burry's Big Short weren't just happening in a vacuum. There was this perfect storm of macroeconomic worries building up in the background, creating what they call a wall of worry for investors. It was really a triple threat of uncertainty. First, you had CEOs from the big banks coming out and publicly warning about a healthy 10 to 20% correction, which is basically code for "we're getting nervous." Second, a government shutdown was just dragging on, making it impossible to see what was coming next. And third, the Federal Reserve was sending all sorts of mixed signals, leaving investors totally guessing about a potential rate cut in December. And that shutdown was really starting to bite. It hit 35 days, tying the all-time record. Now, this wasn't just a political headline, it was causing real stress in the plumbing of the financial system. It was creating what they call a liquidity strain, which just made it harder for money to move around. And that just added another layer of risk to an already jittery market. Okay, so how did all this pressure actually play out with specific stocks? Well, the day's biggest movers tell a very clear story. Investors were dumping high-growth tech and running towards safer, more stable companies. Yeah, the pain was really concentrated in those tech darlings. Palantir, NVIDIA, Tesla, all down big. But it wasn't a bad day for everyone. Check out Hertz. The rental car company shot up over 40% after a surprise profit. And Warren Buffett's Berkshire Hathaway had a nice gain as investors looked for a safe harbor. This is just a textbook example of a rotation out of growth stocks and into value stocks. So the big question is, how do you navigate all this? Let's break down 3 potential strategies for whatever might be coming next. All right, scenario number 1 is for the true believers. This is for anyone who thinks AI is a long-term revolution, not a bubble, and sees this whole sell-off as a fantastic buying opportunity. The strategy here is to buy the dip. You'd use any cash you have to gradually add to your favorite AI stocks. Or maybe you'd spread the risk with an equal weight ETF, so you're not overly concentrated in just the biggest names. The core belief is that the AI story is far from over. But here's the risk. You could be trying to catch a falling knife. What if the sell-off gets even worse? You could be buying way too soon. Okay, but what if you're more worried about the broader market? If protecting your capital is your number 1 priority right now, then it might be time to think about a more defensive playbook. This is the classic 60-40 portfolio. 60% of your money in stocks, 40% in bonds. The idea is that the bonds act as a cushion if stocks take a tumble. The belief here is simple: play defense.
But it's not foolproof. The risk is that in certain markets, both stocks and bonds can fall at the same time. And if the tech rally suddenly comes roaring back, you'll probably get left behind.
The third option is to just ride the current wave. Instead of fighting the market, you shift your portfolio into the sectors that are actually working right now. So this strategy means leaning into sectors like financials, healthcare, and consumer staples, companies that tend to have more stable earnings. The core belief is that market leadership has clearly shifted from growth to value. The risk? Getting what they call whipsawed. That's where you sell your tech stocks right before they rebound and buy into defensive stocks right before they fall out of favor. It's a tough game to play.
Okay, so let's tie this all together. What's the bottom line here? What's the new narrative the market is telling us? And what are the biggest risks we need to be watching?
I think the big takeaway is that the rules of the game have changed, that growth at any price mindset for AI stocks, it looks like it's over. Investors are now demanding actual profits and reasonable valuations. The money isn't leaving the market entirely, but it's definitely rotating into safer, more affordable places. So you're left with two very different stories. The bull case, the positive spin, is that this is just a healthy correction. It's washing out all the speculation. But the bear case, the negative view, is that this is the first real crack in a massive AI bubble. And the fact that stocks and crypto fell together, that could be a bad sign that leveraged investors are being forced to sell whatever they can. So looking ahead, it really boils down to two huge risks. The first is contagion. Does the pain in stocks like Palantir start spreading to the entire AI ecosystem? That is, without a doubt, the market's biggest vulnerability. And the second risk is a liquidity squeeze. Does all this stress from the shutdown and the Fed actually cause a credit crunch that forces a huge wave of selling across everything? And that leaves us with the ultimate question every single investor is asking right now. Was this just a healthy cool down, a necessary breather, and a long-term bull market for tech? Or was this the sound of the first crack appearing in the dam, signaling that a much bigger flood is coming? That right there is the multi-trillion-dollar question.